Let's just talk about the price cuts in Tesla, down another 4%, as you're noting in your notes to us, down about 19-20% year to date. They're leading the pack here, and they got a little bit of room to run. Just wondering how long they can keep this up.
Yeah, I mean, they're in a unique position, right? Because they have kind of the best cost structure, right? They don't advertise, they don't have dealerships. So I think they have the ability to cut prices more than a lot of their competitors. They're also obviously earlier to EVs than others. So it's a great way to really steal market share, I think. And ultimately, they also have a lot of things that kind of go in their favor. They're the biggest beneficiaries of the IRA tax credits this year. And also two of their plants, Berlin and Austin, are really ramping up, and those are going to reduce costs over time. So, yeah, I mean, it looks like a big headline, right? Cutting pricing by like 20% for some of the models. It sounds pretty dramatic, but when you really look at how they can lower costs, it's really a great way for them to gain market share. There will be some near-term pressure on profitability, no doubt. But I think the market really understands this. And you're seeing the stock reaction. It was down more this morning digesting this news. And now it's really come back in. So I think the market is really digested a lot of these price cuts.
So that's interesting then, their time. I guess because really the trend has been that Tesla has been losing its market share. But you think that these price cuts are actually going to reverse that? Am I understanding that?
Yeah, I mean, losing market share is kind of an unfair thing just because there's new entrants coming in that didn't exist before, right? So obviously they're going to lose market share, but that's coming off of such a high number where they were the only game in town. But really, it is a rising tide lifts all boats. Tesla wants other EV makers because the biggest competitor to Tesla is actually non-EVs.
I think that could be a challenge for them. So I'm calling from the low end of their guidance range. And then I do a sum of the parts valuation, and I come out to a $12 per share valuation. That isn't to say that, the pro business they have is amazing. It's one of the best businesses in autos. It's just that EV drag is just really painful for these guys.
Right now, pure battery electric vehicles are the most expensive as a group on the market, right around $50,000 on average. When you step into plug-in hybrids or hybrid vehicles, gosh, those can start with a Prius in the high 20s, and you're getting tremendous gas mileage. So there is a gap. Think in simple terms, pure battery electrics are fantastic, fun vehicles like your Teslas, but they're expensive and you need charging. The plug-in hybrids and the hybrids, your range anxiety goes away because you have the engine to power the cars.
These analysts just raised investors' fears with their latest comments. Remember that thrilling feeling when EVs burst onto the scene? All the buzz about saving the planet, zipping around silently and leaving gas stations in the dust? Well, these might just be a bit of a glitch. Lately, the EV market seems like it's hit a pothole. Startups are folding faster than a paper airplane in a hurricane, and established players are feeling the pressure. Even big analysts like Cathie Wood are sounding strong notes of warning.
GM and Ford have said, we're stepping back. We're not going to do this until it's profitable. The problem with that is in order to be profitable, they need to scale. That's how this works. These are learning curves that they are riding down, and those are expressed in cost.
The EV dream could be turning into a nightmare. Judging by the recent sale of the market and how companies might be throwing in the towel, we fear bigger woes are on the way for the EV market, and it's best to fasten your seatbelts. It's no new news then that the initial EV boom seems to be cooling down. Funding for EV startups has dipped, and some high-profile players like Faraday Future and Lordstown Motors have called it quits. Even industry giants like GM and Ford are facing challenges, and some of these companies have had to cut down on their EV production forecasts. Today we're going to expose the actual truths of this whole EV saga and reasons for the repeated fallouts, and which companies are able to survive these hard times. So listen to this recent interview.
Michael, let's talk about battery electric EVs, because I mean, at the end of the day, that transition is happening, even if the pace of the transition is slowing. So much of the battle between the US players particularly and the Chinese players have been happening in China, the world's largest EV market. Something caught my eye earlier this year when you put out a prediction that suggested that fight is going to shift over to North America. Talk to me about what you're seeing there and how long until a company like BYD, for example, you think actually gains access into the U.S. at a much cheaper price point?
You're exactly right. What we're seeing inside China is that as the economy slows, they have massive overcapacity, up to 10 million units of overcapacity. So all automakers in China are now setting their sights on global markets, pushing out to anywhere they can sell their cars outside of China. Last year, China surpassed Japan as the #1 exporter of vehicles globally, and they're just getting started. Companies like BYD and others definitely have their sights set on Europe, where they're already moving in, and on the United States. Now, here in the US, there's this thing called a 27.5% import duty that has really stalled the Chinese advance when it comes to the American market. But there's no question that Chinese automakers need access to Europe, the United States, and other global markets.
Building EVs is not cheap, and battery tech, a crucial component, is expensive. And supply chain issues aren't really helping either. This single factor pushes up production costs and makes it harder for startups to compete. And it forces established players to raise up prices. I mean, who wants to shell out for a small fortune when they're buying an electric car or an ICE vehicle? In these uncertain economic times, no less. Probably not so many. Hey guys, welcome back to Tesla Tomorrow. Remember when Tesla was the Lone Ranger in the EV Wild West? Not anymore. Legacy automakers like GM, Ford, and Toyota are now serious players offering their own compelling EV options. This increased competition puts a lot of pressure on startups, and it forces established players to constantly innovate and adapt. It's a long, tough game, and not everyone can keep up. But that's not even the real issue. Lately, these competitors are finding it hard to survive. For instance, Ford has previously announced it's going to cut planned production of its all-electric F-150 Lightning pickup truck roughly in half this year, marking a major reversal for the automaker's significant increased plant capacity for the EV in 2023. The automaker had previously withdrawn its plans for a full-year results forecast due to uncertainty over the pending ratification of its deal with the UAW union, and warned of continued pressures on electric vehicles. The single move right here sent shares of Ford down nearly 4%, and it signaled a stiffening market for electric vehicles. What really is the future of EVs and the market? Let's find out, but before we do, if you like this type of content, hit that like button, subscribe, and turn on post notifications to keep up to date on everything going on with Tesla. Just like Ford, GM announced in October that it was abandoning its goal of building 400,000 EVs from 2022 through to mid-2024, and has delayed production of electric pickup trucks at its plant in Michigan's Orion Township by a year. And that's not all. GM also went further to scraping a $5 billion plan to jointly developing affordable EVs with Honda Motor. So will more EV makers drop out? Well, probably. The market will likely see consolidation, with well-funded players, strong technological advancements, and established brands weathering the storm in its entirety.
We're tracking Ford here this morning. Ford riding high off of its fourth quarter earnings beat. Shares up a little more than 2.5%. The company projecting a full-year profit outlook that beat estimates here. One blip. The automaker still sees more losses in its EV units amid an industry-wide slowdown in demand. Consumers still aren't sold on vehicle pricing, lack of charging stations, and battery range. Ford CEO Jim Farley spoke about the company's EV investments, touting an internal team that's working on making a low-cost EV to compete with Tesla and Chinese OEMs. For more on this, we turn to Tom Narayan, who is the RBC Capital Markets lead equity analyst for global autos. Also with us, we've got Michelle Krebs, who is the Cox Automotive executive analyst. Michelle, I'll begin with you because as we think about this broader kind of landscape for many of the auto manufacturers, especially the big three here in the U.S. that have had to look across their own ambitions for EV saturation and had to pull back on that just a little bit, where does that then shift some of the focus in this near term from your perspective?
Well, we've said that the focus, the forecast now is gone from rosy to realistic. I think what has happened is everybody's on the EV train, and but not all consumers are. And so We're seeing a lot of new models, a lot of production of EVs, but the demand is not there. That's not to say that EVs aren't still increasing in sales. We anticipate they'll have another record year this year as they had last year, but it is forcing automakers to look at what is their timeline in terms of rolling out new EVs and how they're going to spend their money.
Tom, when you take into account what we did hear about the EV strategy, the shift that we have seen play out of Ford, comparing that to the rivals and the other automakers that I know you cover very closely, how does Ford stack up to some of its largest competitors?
Yeah, and I think we learned that from the call yesterday. I think Ford intentionally went headstrong into they were an early adopter of EVs, and I think it's kind of hurting them right now, to be honest. Take a look at Stellantis in the D3. They were kind of later to the game, and it's kind of benefiting them. Ford really has no choice but to really commit. That said, at the end of the day, this is an evolution. We are moving towards electrification. So these bets will eventually pay off. It's just that right now, and we heard this from the Tesla call as well, we're in between two waves, and it could be a little challenging for some time.
And so how do you price that into the valuation from your perspective, Tom?
Yeah, so I look at the guidance that they gave, 10 to 12 billion of EBIT, and my EBIT actually didn't change all that much. It stayed at around 10 billion of EBIT, and the reason is I do think these EV losses that they're calling for, if you annualize the Q4 losses, you get something like negative 6.3 billion, and they're calling for 5 to 5.5 billion. So, I think that could be a challenge for them. So I'm calling from the low end of their guidance range, and then I do a sum of the parts valuation, and I come out to a $12 per share valuation. That isn't to say that the pro business they have is amazing. It's one of the best businesses in autos. It's just that EV drag is just really painful for these guys. It's half of their entire EBIT is coming from that, and we just don't have the evidence yet that that's going to turn around next year, even though they say it will.
Startups with limited resources and less differentiated offerings might find it a bit difficult to survive the challenges of the market, and even companies like Ford and GM might not be able to do much. However, for a company like Tesla, the story could be different. For any company to stay ahead of the EV game, there's a few things it's got to do. First up, it should be a tech company. The EV game is all about pushing boundaries and making cutting-edge battery tech that changes faster than your phone. And so a top company must always invest in R&D because that is the secret weapon. Also, a company like this should cater to different tastes with a variety of models. Sleek sedans for city slickers, rugged SUVs for advanced adventure seekers, and maybe even a futuristic, funky electric tricycle for all the unique souls. A true EV leader needs variety. Let's also remember the pricing and how important it is. Nobody wants to break the bank just to get an EV, so leading companies must offer competitive prices without sacrificing quality, and charging should be no hassle. The lack of widespread charging infrastructure, especially fast charging options, is a major pain for EV adoption. And we will see significant infrastructure upgrades, and that will reduce range anxiety, but it could still be a big barrier for many drivers. Range anxiety is a real turnoff, so every EV maker needs to make sure that they go the distance to address this with a robust charging network. And they've got to be willing to partner up with charging companies, or build their own superchargers to make life easier. And now you'll agree that with these criteria that we've mentioned, only one company fits the bill, and that's Tesla. You see, the EV business is all about sustainability. And sustainability isn't just a buzzword, but it's the key to the future. And that's why other legacy automakers are falling off the ladder. A true maker like Tesla has got to be an eco-warrior, sourcing its raw materials responsibly and showing the world it's serious about protecting the planet.
Tesla, which everybody has been out on a bit of late. I mean, 1 month down 15%. It certainly has been getting hit. 6 months down 20%. It's well off the $300 that it was. And you actually are feeling a little bullish on this one. Tell me a little bit about this.
All right, a couple things in this particular fund. Yeah, absolutely going to take a bullish, and this is going to be a call ratio back spread on Tesla. So before I even get into why the bullish call over here, I want to explain just a minute amount of the trade. This is a trade that is definitely bullish, and it's going to be wildly bullish. But if we're dead wrong, we can still produce degrees of profitability, which I'll explain here in a moment. Now, That being said, yeah, Tesla, year-to-date basis, it's not pretty. The stock's down about 25%. In large part, though, I think this has a lot to do with the AI, what I term craze, and moreover, like NVIDIA fever. You mentioned AI, you mentioned NVIDIA. I mean, we have a firm, BMR, that just partnered with NVIDIA that's up, ridiculous percentages in short amount of time. Once that actually wears off, once we start to see maybe a little bit of the NVIDIA craze kind of die down, I think we're going to see a rotation back into areas like, for instance, Tesla, even Apple. I mean, Apple is basically flat on a year-to-date basis. Tesla's down 25%. There's no love in what has been.
As you mentioned, NVIDIA, yeah, I'm sorry, I thought you were finished there. I want folks to know we're going to be talking NVIDIA in our next segment. Ben, your thoughts?
Yeah, this one, unfortunately, we're not going to come to agreement on Tesla either here, because I think that we're coming under pressure, and I think we just took out a key level. I'll show you that on the daily time frame. Let's just begin with a 5-minute candle chart. Some of the selling we're seeing with the broader market weakness. Tesla's come under pressure here. You can see shares just this week from 195 down to 181. No rejection of that, right? We're just consolidating, accepting this new lower level. Again, this is a 5-minute candle chart, so we don't want to put too much credit into this, but it does speak to the two phases of development that we look for. High conviction on the left side of your screen, again, as we're seeing lower lows, lower highs, and then we go into this very much wide range kind of consolidation phase, overlapping, rotational, very random, horizontal type development. So right now balancing around 185, kind of teetering around that level. Let's add a little time onto this chart. Going back to when the stock was trading up around 270, 250, 260 area. We're talking back in the end of December, beginning of January, and you've got another easily identifiable, well-defined trend to the downside here. Let's take a look. 60-minute candles here we're looking at, and 4 areas where the market paused and kind of regained composure, currently teetering around this 185 level. But it looks to me like as long as we're below 214, bears are still in control. I think with the last one with Walmart, I said that the bears were in control there, but there's definitely a bull trend in Walmart as well. But bears in control in Tesla. Let's step one more time back. I want to show you what's going on the daily time frame. And this is why I think this is key. You're going to see that Tesla actually was trending higher. We were seeing areas of value for them at higher and higher levels since the beginning of last year. 118, 180. There's that move you mentioned, Nicole, up to 300. But since we had gone sideways, balancing around 240, and while we were doing that, what are we going to be referencing? 180. The bulls did not want to see us take out 180 in continuation of this series of lower highs here off that 300 level. Look what's happening. We're taking out 180 right now. So a key area right here, I've got to side with the bears on this one, considering the series of lower highs we've seen and the other 2 shorter time frames we're seeing weakness and bearish type pattern playing out here. 180 is a big level. Let's watch that this week.
Yeah, so we'll watch for that. And also it's worth noting that, with their facilities that they have in Mexico, they've actually been bringing in some Chinese suppliers to work with them in Mexico and build some parts there. I thought that was an interesting tidbit. But your final thought, Ben Lick, Don Kaufman, your final thought.
Yeah, with the back spread actually that I've got planned in here, look, if the bearish move continues to play out, we'll still have a very small credit. But the move to the upside needs to be absolutely explosive above like 220 level, and we're back in a very profitable trade. Again, it's selling the 185 calls one time, buying 2 of the 200 calls. Trades done for $1.30 credit. So in that back spread, there's definitely risk, but there's explosive upside potential in the event that Tesla rebounds. If it does fall flat on its face, we still get to keep the $1.30 credit. It's a nice position for what is a wild child inside of those monsters of tech.
Tesla is the celebrity of the EV world, and it's been dominating for a while. While this may seem like an easy achievement, it's gotta be important to remember though that Tesla has a first mover advantage. The automaker was early to the party and launching cool EVs while others were still gassing up their rides, and all this gave up a big market share right to Tesla on their doorstep. And it led to a big understanding of the tech industry and a building of brand loyalty. Tesla has always had savvy rides. Think about it, Teslas are packed with features like self-driving, sleek interiors, and it all makes them feel like spaceships compared to older EVs. And the automaker's built its own charging network, and it's given Tesla owners a peace of mind while on the roads. You see, the EV race is a marathon and not a sprint, and so by focusing on innovation, catering to diverse needs, And offering value and building a strong community, Tesla's well on its way to leaving the competition in the dust. And let's also remember that Elon Musk is at the forefront of Tesla, and his constant buzz keeps the company in the spotlight. All this makes Tesla the undisputed king of the industry, and we doubt anyone else is going to take that crown.
We've seen the price wars play out. Obviously, it has been a challenge, a headwind here for so many of these automakers. When you take into account, Michelle, what we heard from Jim Farley last night, also the fact that Ford now seems to be focused on this cheaper EV, do you think we're going to see continuation of these price wars, given the fact that consumers are very much still under pressure?
Absolutely, especially in the EV segment. We have double the inventory of EVs that we have of regular gas power or total vehicles. And so that means there will be more incentives, there will be more discounts, there will be more price cuts. So it's going to be a very cutthroat business in the next year or two.
And with that in mind, what do consumers need to see from what you're hearing on the Cox Automotive side in the broader infrastructure for electric vehicles to feel comfortable buying into them, to get to some of the targets that Tom was just talking about these automotive manufacturers have laid out?
Well, first of all, price. That's always been the number one barrier for EV adoption, especially as we move into the more mainstream buyers. So far, a lot of the EV buyers have been very affluent. They probably have multiple vehicles in the household, but now we're moving into that heart of the market, and that's going to be a bit of a tougher sell. So price is one, but the EV charging infrastructure, it needs to be more expansive, but it also needs to be maintained, because we have seen just horror stories there was one in Chicago during the storm of, people waiting for chargers. They drive up to one and it's not working. So that's got to be worked out as well.
Just lastly, would love to get an answer from both of you on this. When you think about the interest rate environment and how much consumer sentiment is tied up within that, especially for financing large purchases like automobiles, if we do see cuts and the pace of cuts perhaps that were anticipated by some consumers and economists out there for this year, what will that do in terms of perhaps a dam-breaking type of moment for people getting back into purchasing in the automotive market? And Michelle, I'll go to you first, and then Tom, would love to get your thoughts.
It certainly will be a huge help. High interest rates have pushed a lot of people out of the market, have pushed the monthly payment really high to the point that some people just walk away. So that will be a huge benefit. I would say the number one thing for consumer sentiment, though, is gas prices. If you watch gas prices, that's where consumer sentiment goes. But interest rates are not far behind.
Fair point. Tom?
Yeah, I totally agree with that. The interest rate environment is what Elon called out every one of his earnings calls, right? It totally impacts affordability. What we're noticing, though, is that the pricing is at all-time highs. So the concern would be is if affordability is in question, if pricing collapses, that is really problematic for these OEMs. So if interest rates do come down, affordability is maintained, they could have another record year of profits. So
traditional automakers are waking up. The big guys like Ford and GM are finally launching their own EVs, and some of them do look pretty good. But it takes more than just aesthetics to survive. Affordability matters. Even though Tesla cars were once very pricey, the automaker has taken steps to lower car prices, although this move significantly affected its revenue. And so, is the EV market really doomed? Well, not necessarily. While challenges do exist, there are also reasons to be optimistic. For instance, governments are investing in EV infrastructure, battery tech, and constantly improving it. And consumer interest in sustainable transportation does remain strong. No doubt the EV market is at its crossroads, and it's got several hurdles. However, the potential for a sustainable future is too great to ignore, and companies like Tesla can adapt, innovate, and navigate through the current challenges, which will be the ones to truly ride the electric wave to be a greener tomorrow. So will Tesla stay on top? Well, we can't say for sure because the future is uncertain. But what we do know is that the one with the best tech, affordability, and maybe production cost could win the hearts of EV users. Stay tuned to the EV race as it's far from over, and it will be an interesting ride. What do you think? Will the EV market continue to get tough for car makers? Let us know down below, and if you want to know more about what Tesla's been up to over the last few days, go ahead and click on this next video on your screen. See you there.